Hello to all traders and welcome to another webinar that shows us the beginner's guide to Elliott Waves, hosted by myself, David Kindley. Last week we delved into harmonics, and this time I've had a few requests about Elliott Waves, and well, I've had to answer those calls amazingly, and we have had a lot of interest in Elliott Waves, so let's get right on to it. Thank you once again for joining me, and as I say on all my webinars, any questions that you want to direct at me throughout this webinar, please feel free to do so, and I'll answer them as quickly as I can, depending on the time that we have. So going into the introduction to Elliott Waves, I just want to show and to go into a brief introduction, not a big introduction, because obviously it gets very boring when people get big introductions. So just a quick few bullet points. So Ralph Nelson Elliott originally created the Elliott wave theory. He believed that the markets traded in repetitive patterns such as waves. He discovered a recurring pattern that operated between market swings, market high and low swings. He theorized these patterns and names and called them waves. And also using the wave principle, he was able to forecast reversals in the market with quite a high degree of accuracy. A lot of people would say that it's not really such a high degree of accuracy, but it has been proven in the past that Elliott waves can be very, very accurate. So let's just see what we are looking at here. So I try to break it down as simple as I can in the basic concept. And that is basically the Elliott wave principle illustrates the structured progression of prices in waves. So fluctuation and development in linear movement occurs when 5 waves progress and 3 waves revert. This is a full 8 cycle and composed of 2 parts. So what I've tried to do here is break it down as easy as I can with the colors and letters and numbers. So the 2 parts of the wave development are the motive and corrective, and they are labeled in numbers and letters. So the motive is going with the direction of the trend. So if we've got an uptrend, then this is a motive trend. I've labeled it in black, and it's always in numbers. So 1, 2, 3, 4, 5, for example. And corrective phases are in letters A, B, and C. So it's important to understand that anytime you see numbers, it's going as a motive with the trend, and anytime you see letters, it shows as a corrective trend. It's going against the direction of the trend. Waves in bullish markets will always show 5 waves up and 3 waves down. And conversely, bearish markets will show 5 waves down and 3 waves up. So as I said here, just try to point it out as clearly as I can in that respect. So we've got here as an impulse, let's say. We're going to into all the patterns shortly, but I just wanted to get you into the basics at the moment. So we're looking at 1, 2, 3, 4, 5. So it's motive because it's numbered, and corrective ABC because it is going against the trend. So very important to understand that as well. So let's go on to the next slide. And this can be a little bit confusing, but I've tried to keep it as basic as I can and explain everything in detail. So each smaller cycle is part of an expanding mix of larger structures composed of bigger cycles. To simplify cycles and their duration, Elliott characterized those numbers and letters from large to small to form what is commonly known as wave degrees. So let's just take our attention to this diagram here on the right-hand side. So I'll just quickly shoot back to the previous diagram. So we've got 1, 2, 3, 4, 5, but in these waves, they can be broken down into smaller cycles, smaller waves. And that's what I'm just trying to point out here. So we've got this one wave here, which will be this one wave. And in that wave, as you can see here, we've got different patterns. So for example, the basic way we can explain this is we've got a 1, 2, 3, 4, 5 pattern, 5 pattern to the upside, which creates wave 1 of the larger degree. And then we've got an ABC corrective move, which completes wave 2. And that gives us a corrective move to the downside. And then we go back up to wave 3, wave 4, and wave 5. And if we're feeling adventurous, we can actually have a higher degree, which completes a primary wave or any wave that's higher. So before we get into the technicals, let's just see what wave degrees we have. So we've got grand supercycle, cycle primary, intermediate, minor, minute, minuet, sub-minuet. We've got a couple lower as well than sub-minuet, but there's no point going into them ones at the moment because this is the duration we're looking at here. So this is what Elliott and a lot of other traders usually use to identify the different cycles. So as you can see here, these numbers have got around circle around them. These are in brackets or parentheses. These are on their own. Again, these are in a circle around them, but they're differently stated. So as you can see, 1, 2, 3, 4, 5. This is in Roman numerals. So they're just basic different types of showing the waves structures so that they can be different to the trader's eye. So that's just literally what all these numbers mean here. So I know that if I see a primary wave, I know that's going to be a normal number, not Roman numerical, and it's going to have a circle around it. So that's basically what it is. And then we've got a time period. So the most common, you could say, are, let's say, cycle, primary, intermediate, minor, probably this section in the middle here, because if you look at the time periods, you can see that they're quarterly, monthly, weekly, daily here again, 240 minutes, weekly, daily, and you can see hourly or few hours old, 4-hour chart here. And then you've got obviously the less and less minutes, depending on what chart you are using as well. So this is the basic structure of Elliott waves at the moment. So let's just take a look at explaining this diagram here. So primary wave 1 in the blue has 2 corrective waves. So we've got intermediate waves 2 and 4, and this is because they're going against the trend. So as you can see here, they're corrective because they're not going towards this primary wave 1. They're taking a step back basically. So we've got wave 1, which is going with the trend. So it's motive. Then we've got corrective, motive, corrective, and then motive again. So this whole wave here, as you can see, the primary corrective wave 2 also has a low degree correction in minor wave B. So what does that mean? So this whole wave here is corrective because it's going against the trend. However, this wave B is also going against this corrective trend. So that's what I mean here. The primary corrective wave 2 also has a lower degree correction in wave B. And it's a minor ABC wave, ABC here. And the reason this is minor is because it's under the main wave here. So we've got here, which is a primary wave 1. And then underneath that, we've got the intermediate wave 5, as you can see here, which is the red 5. And then underneath that is the black 5, which is the minor wave 5. So you can see these degrees that they're going in tandem. This is higher degree than this 5, and this 5 is a higher degree than this 5. So it's basically stacking the waves in order. And this is how we look at the Elliott wave cycles as well. So the intermediate wave B is considered correction now, like I just said, as it trades against the impulse waves corrective trend. So as you can see here, this is all going to against the trend, so it's corrective. However, this wave B is considered corrective in this correction because it's going against the A and C waves. So A wave here is 1, 2, 3, 4, 5 to the downside, and the C wave is 1, 2, 3, 4, 5 to the downside as well. However, to the upside, we have an ABC. So this is corrective against the whole trend. As I said, any questions that you want to throw at me, just to have confirmation, let me know. But this is the basic principle of the Elliott wave theory, looking at the trends as well. So moving on to the patterns and the waves. So for motive waves, the most common motive wave is an impulse. And now what is an impulse? So as you can see here, on a bullish or bearish degree, we have 1, 2, 3, 4, 5 waves. And conversely, 1, 2, 3, 4, 5 waves to the downside. And here are the general rules. Now, what I want to go through the general rules is these are the most simplified rules for the patterns and the waves. There are more extreme rules to take into account, but that will be on the next webinar when we go to a more intermediate and actually advanced Elliott wave strategies. But at the moment, we're just looking at the basics, not to jump too far into it. So an impulse wave always subdivides into 5 waves, as we just went through there. Wave 3 is never the shortest wave. So basically, wave 3 doesn't have to be the longest wave. However, it cannot be the shortest. That is a firm rule. Wave 2 never moves beyond the start of wave 1. Now, what does that mean? It means that wave 2 here will never delve below or higher than when wave 1 started. So with that being said, we can see that wave 2 will never go further than the start of wave 1. Wave 3 always moves beyond the end of wave 1. So this means that wave 3 will never basically be around here or here. It will always push through and finish higher than wave 1 or lower than wave 1, depending if it's a bullish or bearish move. If wave 5 does not move beyond the end of wave 3, this is called a truncation. Now, basically what that means is wave 5 is allowed to end lower than wave 3, and it will be a truncated impulse, but this rarely happens. I just wanted to point out that it could happen. Usually wave 5 does end above or below wave 3, as in the diagram here. And wave 4 usually never moves beyond the end of wave 1. Now, I've highlighted that usually because on my next slide, I just want to show you the truncation. So truncation in an impulse, this is what I want to just point out. So it always appears in wave 5, and we basically see it because it's a failure to move beyond the end of wave 3. So this is what, I'll just go back to the other screen. So this is what a standard impulse would look like. As you can see here, wave 5 is vastly above wave 3 and vice versa on the bearish leg. However, on a truncation, we've got 1, 2, 3, 4, and wave 5 on the other diagram was finishing higher here or lower here. But as you can see here, it is actually ending below or above wave 3, depending on if it's bullish or bearish. So this is what a truncation means in that respect. And also on this point here, wave 4 usually never moves beyond the end of wave 1. I just want to show you that in a diagram. So this is why I pointed this out, another diagram here. So we've got an impulse 1, 2, 3. So it's moving okay at the moment. Then we've got wave 4. However, wave 4, as you can see, at the moment, it's moved in the territory of the end of wave 1, as you can see here. And this is an exception. So if wave 4 is a triangle, which we'll see shortly, we'll see this diagram shortly, what a triangle is, then the triangle must end outside of wave 1. So a triangle is basically a 5-wave move, as you can see here, 1, 2, 3, 4, 5, all in a triangle, as you can see from the dotted lines. I'll just try to highlight that a bit better. Now we've entered the territory of wave 1, but we've finished outside of wave 1, the ending of the wave. So as you can see, basically forget this black line in the middle. I just want to show you a typical wave. This has kind of gone into a triangle. So it's gone quite a big zigzag shape here, but it's finished outside of wave 1. So it's accepted. And then we've gone bouncing up to wave 5. And here it is in another diagram. So we've gone wave 1. This is an internal structure, by the way, so don't be confused. So we've gone 5 waves in wave 1, an ABC correction in wave 2, and then another impulse, 1, 2, 3, 4, 5 to wave 3. And then our wave 4, as you can see here, is entered the territory. And because it's a corrective move, because the triangles are corrective, it's in letters, A, B, C, D, E. And then we've seen now that it's finished above the end of wave 1. So it's accepted. And then 1, 2, 3, 4, 5 to the upside to complete wave, the final wave 5 of wave 5 here. So this is what I just wanted to point out, because it can get confusing and we can see a few of these exceptions, but I just wanted to show one exception because there are a few other exceptions as well, not just with impulses, but with many other patterns as well. So counting the correct rules in an impulse. Now, I've just done a little pop quiz for you guys at the moment. So I've highlighted which is the correct and satisfactory impulse, but I'm wondering if you can guess which one, the reason why, sorry, the third diagram is correct and accepted. And I'll just give you a second to just have a look and see if you can let me know why you think the third diagram is acceptable. Okay, Datsu from India has said he thinks wave 3 is acceptable because wave 3 is the shortest in the diagram, is not the shortest, and that is correct. So let's just go through each one just so that we're clear. So here we're seeing that we've got wave 1, 2, 3, 4, and 5. However, as you can see, wave 4 has ended in the territory of wave 1. So this is not acceptable. In our last diagram, it started in wave 1. However, it didn't end. So wave 4 cannot end in the territory of wave 1. So this is cancelled. The second diagram, as you can see here, wave 3 is the shortest wave. So we've got a very big wave here on the 5th leg, and the first leg is quite big. But as you can see here, the 3rd wave is the smallest. So this is not acceptable in an impulse. Wave 4, sorry, diagram 4, we're seeing that wave 2 has gone beyond wave 1. We've entered the territory of wave 1, and this is not acceptable. This is not a rule in an impulse. And the correct one, so we've got one wave, sorry, the 2nd wave, 3rd, 4th, and 5th. Even though wave 1 is bigger than wave 3, it's not the shortest wave, because wave 5 is shorter than wave 3. So this is acceptable and it's correct. So I just wanted to give you a little pop quiz, a little diagram into how we look at impulses in Elliott waves and how complex they can be. However, they can be accepted in this format as well. So just very important as well. So thank you for taking part in that, especially Datsu that got the question correct. So let's look at other patterns there. So the other basic types of motive waves are diagonals. So they come in 2 different patterns, leading and ending. So I've tried to keep this all in one diagram so it's a lot easier to see. So we've got ending diagonals and leading diagonals. Now, the basic rules for leading diagonals is it occurs in the first wave of an impulse or wave A of a zigzag. We'll look at zigzags shortly, but because it's leading, the clue is in the name. Leading means we are starting the wave. So it can only be in the first wave of these 2 patterns. Conversely, ending diagonals only form in the final waves, the final 5th wave of an impulse and the final wave C of zigzag and flats. Again, we'll look at these shortly, but the clue is in the name. Ending, meaning it's ending the pattern. Leading means it's beginning. So we're only going to find this in a first waves of a pattern. They usually subdivide into 5-3-5-3-5 structures. Now, what does that mean? It basically means that it can also sometimes be a 3-3-3-3-3 structure as well. Now, this basically means that within the lower structure, we can have 3 or 5, 3, but here I've done it 3-3-3-3-3, so it's a little bit easy to see. So imagine this is the first wave. So in this, we've got a 3, a 3, a 3, a 3, and a 3 to make up wave 1. And that's what I'm trying to point out here. So 1, 2, 3, 4, 5. This is the 5 legs to make up this wave 1. And this is how we see the leading diagonal. And that's how we look at the basic rules for a linear diagonal. Ending diagonal, conversely, again, they always subdivide into 3-3-3-3-3 structures. And again, this basically means at the end of the pattern, we are looking at 1, 2, 3, 1, 2, 3, 3, 3, 3, 3, 3, and that ends our wave 5 of the intermediate wave 5. So again, if you imagine this is an impulse, 1, 2, 3, 4, 5, but inside the internal structure of wave 5 in black, we are having this structure as well. So this is how we identify ending diagonals, and we know that it's coming to an end. I just wanted to point out that this is a bullish contracting and a bearish contracting. Contracting means that the diagonal is going at the smaller at the end and it's bigger at the beginning. And conversely, we're looking here that the contraction is towards the wave 1 here. So general rules for diagonals. So wave 4 usually enters the price territory of wave 1. So this is quite a common thing. So as you can see here, try and make it as easy as possible. So wave 4 here, as you can see, it's in the territory of wave 1. And same here for the bullish contracting, and same here for bearish contracting. So wave 4 is usually entering the territory of wave 1. Wave 2 never goes beyond the start of wave 1. Wave 3 always goes beyond the end of wave 1, and wave 4 never moves beyond the end of wave 2. So this is basically a contraction. So as you can see here, it basically means that as we go, wave 2 is smaller than wave 1. Wave 3 is usually smaller than the previous wave. And as you can see, wave 4 and wave 5, they get smaller and smaller. So these are the general rules of diagonals, and they come in 2 forms, leading and ending. So just try to make that as clear as I can. Again, any questions that you want to direct at me, let me know. So moving on, we've got corrective wave now. Now, if you remember from the beginning of the webinar, we've got motive and corrective. So corrective is going against the trend of the market. So the most common corrective wave is a zigzag. So we've got bullish and bearish. Now, what this is just a simple A, B, C. Because it's corrective, it's made up of letters, A, B, C. And then I've just broken it down so that you can see possibly in this wave and this wave and this wave, what we are looking at here, because it consists of a 535 subwave. So 535 subwaves means that we've got 1, 2, 3, 4, 5, and then 1, 2, 3, and then 1, 2, 3, 4, 5. And that's making up this exterior of this zigzag pattern. And conversely for bearish, it's going the opposite direction. So 1, 2, 3, 4, 5, ABC, because corrective is letters ABC, and then 1, 2, 3, 4, 5. So the basic rules of zigzags are wave B never moves beyond the start of wave A. So we've got wave B here, so it will never fall into the territory of wave A here where it starts. It's always going to be just a slight move to the downside or upside, depending on if it's bullish or bearish. Wave A always subdivides into an impulse or leading diagonal. So wave A, like we saw before, it's always going to be an impulse or leading diagonal. So we can know that it's going to be an impulse for wave A, which is this 1, 2, 3, 4, 5, or we're going to have a leading diagonal, depending if it's bullish or bearish, 1, 2, 3, 4, 5. So you can see how now the waves are kind of starting to come together as one, and you can see that some patterns are conjoining with other patterns as well. So wave C always subdivides into an impulse or diagonal again. And wave C is often about the same length as wave A. So it's very rare that you'll have a large wave C or wave A that does not correspond to the size of them both. So whatever wave A is doing, usually wave C is doing the same thing as well. So very important to note as well. So double zigzags. Now, what we've got here is basically well, it is what it is, double zigzag. So we've gone from a single zigzag or a simple zigzag to a double zigzag. So let's look at the diagrams here. To spot a double zigzag, we've gone to different letters now, not A, B, C, but W, X, and Y. And I've tried to break it down because they subdivide into 3, 3, 3 waves. And what does that mean? So we've got A, B, C, so 1, 2, 3 waves to make up W. And then ABC again, which is 3-wave pattern to make up X. And then again, 3-wave pattern to move up to Y. And this is a bullish and this is a bearish move. Usually waves labeled as WXY pattern, like I said, usually waves W and Y are zigzags. So if we're just going back, W and Y basically consist of these zigzags usually. So this would be a zigzag, ABC, and this will be a zigzag ABC. 2 zigzags connected with an intervening wave X. So this is the intervening wave X. So we've got one zigzag here, and then we've got the intervening wave X, which is usually just an ABC move. Doesn't have to be a zigzag. And then we've got another ABC move to the upside as well. So that's just another look at how a double zigzag is connected. Wave X is always smaller than wave W. And wave Y is always longer than wave X. So let's just go back to this. So wave X, it will always be smaller than this first initial wave. It can never really go beyond the wave W, never go into that territory here. And wave Y, the final one, is always longer than wave X as well. So basically the intervening wave X, which connects these 2 waves, W and Y, is always smaller. And it's just basically a connection. Doesn't really mean too much because we've got the first zigzag, ABC, and then we've got the next zigzag as well, ABC. So these are the general rules for double zigzags as well. Now moving on to triple zigzags. So we're going to another level now, and it's getting slightly, not complicated, but just a little bit more to take in now. So we've got, let's go to the general rules because I think it's a little bit easier to look into. So they're subdivided into 3, 3, 3, 3, 3 waves, which I've labeled here, but I'll go into them shortly. And they are basically determined by W, X, Y, X, Z. Now I put two X's here just to differentiate from the first X, the intervening wave X. So technically it's W, X, Y, X, Z, but some traders will use W, X, Y, X, X, and Z just to kind of differentiate the two intervening wave X's as well. So let's just take a look into how these triple zigzags are made up. So the first intervening wave X is always smaller than wave Y. So this is basically going back to a double zigzag. This will always be smaller than this wave as well. Wave Y always goes beyond wave W. So you'll never see a truncation. And a truncation, like we saw on the impulse, is ending before the completion of wave W. So it'll always be above wave W. Both X waves do not exceed the start of the preceding zigzags. So basically these X waves will never dip into this territory here. So the second X will never go here and the first X will never go beyond there. And wave Z goes beyond wave Y unless it's truncated. So like we saw in an impulse, just quickly go back, we could have wave X finish slightly below the intervening wave, wave Z finish slightly below wave Y, which would be here. However, it's very rare. So I've broken it down into what we can see here. So again, because they're corrective, they're labeled in letters, alphabetic. So it's making up ABC, 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 and ABC. This is the 3-3-3-3-3 pattern. So we've got the ABC to make up wave W, ABC correction in intervening wave X, and then another long ABC because wave Y always goes beyond wave W. Then we've got the second wave X, intervening wave X, ABC to the downside, and then we've got the ABC again going to complete the triple zigzag and then finishing this pattern here. And as I said on the previous bullet point, the general rules, wave Z can sometimes finish around here. However, it is not that common. So just a few things to look into there as well. So coming towards the end of the patterns, we're looking at triangles now. So we've got two types of triangles. We've got expanding and contracting. So let's just take a look. Not to get too complicated, I've tried to fit everything on one slide so that we can see the rules and the images as well. So please, as I said, any questions, let me know and we'll go onto the answers as well. So general rules, a triangle always subdivides into 5 waves. As you can see here, they're labeled in alphabetic. So A, B, C, D, E for all. These subwaves are made up of 3 internal waves. So that means that this is basically a kind of triangle that's not showing the internal structure, but this is. So as you can see here, A to B, B to C, C to D, and D to E. They've got 3 waves inside them. Waves are listed from A to E, and wave B can be any size. So basically, there's not really any rules with wave B, as long as it does obviously have a wave. It doesn't, we have wave A here, it can't finish up here, it has to have a bit of a length, but it can be as big as it wants. So with contracting, a contraction means that at the end it's getting smaller, and expanding, as you can see, it's the opposite. At the end it's getting larger. So wave E is shorter than wave D. So this is shorter than wave D. Wave D is shorter than wave C, and wave C is shorter than wave B. So this is just a basic general rule, because as you can see, if it's contracting, it's getting smaller at the end. So naturally, each wave as it progresses will be smaller than the previous wave. And similarly, on a expanding triangle, each wave will be longer as it progresses. So wave C is longer than wave B, wave D is longer than wave C, and wave E is longer than wave D. And this is all so that it's a basic turnaround in the market. So the market is moving on to the downside, let's say. Then we've completed A, B, C, D, E, and then when we've completed E, we're going to break out of this triangle. And that's the whole concept of expanding and contracting triangles. So we're looking to break out, like I've put here, we've finished wave E, and it's bullish for a reason, because it's a bullish contracting symmetrical triangle. So we're now looking at moving to the upside. So finish wave E, and then boom, we've broken this contraction and we're moving to the upside. And with the expanding, similarly, we are looking to move lower as well. So A, B, C, D, E, we finished E, and now we are moving lower. So we'll see, that's the whole concept basically of what we're looking at the moment. So moving on, these triangles, we are looking at horizontal and skewed triangles. So what I want to just look at here at the moment is, this is the horizontal triangles. And the reason why it's horizontal is because one of the borders of the triangle is straight, it's horizontal, whereas the other one is slightly slanted. So wave B can be any size, like we saw in the previous rules for the normal triangles. Wave C is always less than wave B. Wave D is always less than wave C. And the final wave E is smaller than wave D because it converges at the end, as you can see here. And expanding rules. So again, wave B can be any size. Very important to note that wave B for any triangle can be any size. There's no real rules about that. Wave C is bigger than wave B, that's because we're expanding. Wave D is bigger than wave C, and wave E is usually more than wave D because it expands at the end. So it's just basically an expansion, same kind of concept as the previous triangles, except that one of the degrees will be horizontal, so dead straight. And these can occur. So like I'll just go back quickly. As you can see here, both lines here are moving in tandem, contracting. However, for horizontals, one of the lines is horizontal. We're looking at skewed lines. Now, both lines go in the same direction of the trend. So at the moment, this is an uptrend. So we're moving up. However, we are still moving up in a triangle in every leg. So A, B, C, D, E. And then even when E finishes, we're still moving with the market trend. So this occurs when traders do not follow the formation of a horizontal triangle. So this basically means that there's more buyers in the market here, and there's more sellers in the market for the downturn as well. So therefore, pushing the trend in a certain direction, resulting in a tilt. So as you can see here, in this particular horizontal contracting triangle, it's like there's probably a few more buyers in the market and sellers here, because the market is still kind of moving a little bit higher until it gets to the final wave E and then moves lower. But with the skewed bullish triangle, it's still progressively moving higher until we get that final leg. And same with the skewed bearish, we're moving lower until we get to that NE wave, and then we're moving lower. So after the completion of the triangle, the market is expected to continue the path of the trend. So I've just got a question from Emilia, and she's asking about the skewed triangles. Can they reverse quite significantly in the triangles? Well, not usually. For skewed bullish and bearish, they're going with the trend because, as I said, there's heavy buying pressure in this leg, in the whole wave, and there's heavy selling pressure here. It's not like the previous triangles where there can be a little bit 50-50. Let's say for this one particularly, we're having a little bit more selling pressure because the market is moving more lower, and the same here as well. You could say that there is a little bit of selling pressure because the actual triangle is moving to the downside. However, it is supposed to be when the wave E finishes, going against the trend of full reversal. However, with skewed triangles, we are looking at more of a move to the upside. So with that being said, we've come to the end of the presentation, but not the end of the webinar, because I want to take you through what just quickly the basic concept again. So just remember that motive waves are numbered and corrective waves are lettered. And what Orbex have done, we have actually offered our clients an Elliott Wave indicator download on the NT4 platform. And I'll show you how it's done now, because it's a very, very interesting indicator that can plot Elliott Waves on the NT4 platform and really give us a good look into what can, some very, very good opportunities in that respect. So if you haven't plotted an indicator before, you can download it on our website, and you can actually obviously ask me anytime how it's done. But what I'll do is we open the data folder here, go to File, Open Data Folder, and then we'll go to NT4 QL, and then we'll also just move it so it's a bit easy to see. Go to Indicators, and you'll basically just drag and drop the Elliott Waves indicator in here. So I've got it here. So it'll be Elliott Wave underscore indicator.xe4. And then once it's in here, you can basically refresh your NT4 platform, close and open it, and then it will appear on your navigator. So let's just quick. So there you go, Elliott Waves indicator. So then just drag and drop, and you see this box, okay. And then you see it here. So I'll just move this a little bit so it's a bit easier to see. So what we have here, we have many cycles of wave degrees. So sub-micro, sub-minuet, minuet, the ones that we looked at here on the webinar pages. And then we've got some wave patterns, the most common: impulse, zigzag, triple zigzag, double zigzag, and triangles. And we've got levels and waves. So let's just take a normal impulse, and let's just go to a minor degree, and we want to put in the waves. So we're going to start here. So let's just say that's the first one, 2, 3. We're expecting wave 4 to come down here, and then wave 5 to end here. So this is just a normal impulse that we've got here. Now, if we want to put the levels in, we just click on the indicator and we put the levels in. Now, what the levels mean is basically it's the price of what we've got here. We've got US oil, this is crude oil. So we've got the price of where we think it's going to go. So at the moment, we started at $95.17. Then we've got wave 1, which is just over $100. I'll just move that so it's a bit easy to see. Oops. Just over $100. And then we're back down to $97, up to 103. And then we've got a prediction that roughly we're going to think wave 4 is going to come here, and then wave 5 is going to come here. Now, the good thing about this Elliott Wave indicator is we've also got the Fibonacci retracements. So here we've got 62.8. Now, what does that mean? If we get the Fibonacci retracement out, I'm going to start at wave 1 here, the beginning, and go up to where I finished my wave 1. Now, this 62.8, as you can see here, I've got my 61.8 here. It's roughly about just under that 61.8. So this 62.8 is showing me the Fibonacci retracement as well. So it's a very, very interesting tool. And as you can see here, we're going back up to 124.9. So this is the whole expansion of waves 1 up until 3. And then we've got the other reversal now, and then another move to the upside. However, if you don't want these levels, you can just simply click on the wave and then take the levels off. And similarly, you can leave the levels on and take the waves off, however you feel that you want to see the chart. So just delete that. So just be careful, just keep in mind that you just have to click on the actual, any wave really, can be up here, waves, or click the waves off, click the levels off, and then you can put in what ones you want. And also if you press the letter, if you click on it and press the letter R, you can delete the wave as well. So let's just take a look at another chart. So I've got euro dollar, quite a popular chart. I'm going to put the Elliott Wave indicator on. And I'm thinking that, again, let's go on to the hourly chart. So I'm thinking maybe this looks like a nice impulse to the downside, maybe 5 levels. So we'll go to impulse again. Let's go to primary and let's go to waves first of all. So I'm going to start here. So I'm going to click here. I'm thinking, let's see, this could be wave 1, wave 2, my wave 3, 4, and 5. I'll just zoom that in a bit so it's a bit easier to see. So, and I can put levels as well. So this is basically for you to play around with and make yourself more comfortable with the Elliott wave theory. Again, you could say there's a zigzag of a bigger degree here. So I can start here. Let's go to a primary wave. So start here. We've got 1A. This could be my B. And now that I've finished wave 5, I'm expecting my C maybe to start moving up here, depending on your strategy and also depending on how far you think this is coming. So again, we are looking now, if we just click on here, if I want to go to a super cycle as well, you can go maybe to a daily chart to see how this is turning out, or maybe 4 hours would be a bit easy to see. So in essence, I've accidentally deleted it now, but in essence, you get the general idea. You can go to, let's go to pound dollar. Already got a Fibonacci on there. So again, you could think that, let's just see, Elliott Waves indicator. As I said, you can play around with any of these patterns to make sure you're getting the best out of it. So let's go for a minute impulse. And let's go on an hourly chart. So that's quite a minute impulse waves. So as you can see, that could be my wave 1, 2. Actually, I've done that wrong, but what you can do as well is you can move these as well. So click on it and move it lower. However, it doesn't want to do that at the moment. Let me just delete it again. So click on press R. So I've got levels and waves, my new impulse. Let's try that again. So I'm starting up here. My wave 1, 2, 3, 4, and 5. So I'm thinking that that's going to finish at the end here. And as you can see, I want to just put in my waves mainly. So I'm going to click on this anywhere, take that off, and just put in my 1, 2, 3, 4, 5, just to give me an idea of where I'm looking at for an impulse to the downside. So these are all basic concepts for the Elliott Waves indicator. It gives you it's a very, very helpful indicator. And as I said, the best thing is when it gives you the levels, it's actually giving you the Fibonacci retracements as well. So this is the 100% of wave 1. And then this is the 27.6% retracement of that wave 1 as well. So very important there to take into account. So as I said, this is available on our website, orbex.com, and you can download that today. So let's just have a quick recap on the presentation here. So let's quickly move you through it so it's not too boring. And so we've got the wave degrees, very, very important, and the time periods as well. So if you see basically super cycle or grand super cycle, it means that it's going to be at least quarterly, annually, or even 5 years, 10 years, going even further than that. But the most popular Elliott waves are the ones that are used probably primary, intermediate, minor, and minute because of the times of the day. We've also then just got this diagram here. As I said, primary wave 1 is making up 1, 2, 3, 4, 5 waves. However, waves 2 and 4 are corrective. And why is that? Because they're going against the trend. And wave 1, 3, and 5 are going towards the trend. So these are not corrective. Similarly, in the ABC wave, this whole wave is corrective. However, this particular B wave is not corrective because, so it is corrective against this whole wave because it's going upwards, whereas the rest of the wave is going downwards. So important to note on there. Impulses, they make up 5 waves, and just some general rules here. I won't go through them again because I usually send a lot of the traders the slides, and if you would like me to send you the slides, please let me know your email addresses and I'll be able to send them to you then. And as I said, these are the basic general guidelines and rules for a lot of the charts as well. So wave 3 is never the shortest wave. That's very important. And truncation occurs when wave 5 ends shorter than wave 3. And we've also got this exception as well. So if wave 4 is a triangle, so triangles are made of A, B, C, D, E waves, 5 waves, they can start outside, so in the territory of wave 1, the end of wave 1. However, they have to finish above this wave 1 end line. And we've also got this little pop quiz that I said. So as long as wave 3 is not the shortest, it can be accepted. Wave 2 can never enter the territory of the beginning of wave 1, like it has done here. Wave 3 can never be the shortest, and wave 4 can never end inside wave 1 as well. So something else to keep in mind as well. So Peter's just asking me, can I include a slide on how to derive the waves as I just did with the US oil and cable? Well, sure, Peter. So basically, if we just go to any chart, so dollar yen, for example, let's go to a daily chart because it's a little bit easier to comprehend from looking at waves. Just get rid of my technical analysis here that I had before. So what we're looking at the moment is the fact that this is the beginning of a potential impulse. Now, the way that we look at potential impulses or any patterns is that the market swing highs and lows. Now, at the moment, we've started this big swing and this particular move. So the waves before this, they are looking like they haven't really done much. They're just moving in a slight horizontal, kind of expanding. You could say this is a triangle because we've got A, B, C, D, E. E is finished, and now we're moving into an impulse here. So this could really be a leading diagonal in a way, based on the rules and everything here. So with that being said, now we're at the beginning of an impulse. Looks like we are doing, because if we just pull the Elliott wave indicator on here, so many indicators on here, it's a little bit difficult to see sometimes. So let's go for an impulse. Doesn't really matter the wave degree for now, and levels and waves. Let's put them all in there. So we're starting here because this was when our potential triangle finished. So we'll start here. We've got wave 1, 2, 3. Now we're coming down in wave 4 perhaps, and then we're expecting wave 5 to finish higher up here. So I'll just drag that a bit higher so it's a bit easier to see. So as you can see here, Elliott waves, like any other indicator or any other algorithm or any other trading pattern, is all speculative. And what I mean by that is, depending on if you're using harmonic patterns, Elliott wave patterns, any other patterns in the market, we have to look at the basic concept, that the rules, and see if this is falling in line. So let's just take the levels off so it's a bit easy to see. So I'm believing now that my wave 1 of the impulse is finished. The wave 2 has come down at a good degree. Wave 3 is moving higher. And now we're coming down in the wave 4. Now wave 4 cannot move in this territory, and seem to have messed that up slightly because my Elliott wave is going a bit crazy. So it cannot move beyond wave 4. So if it moves here and ends here, then my impulse is not correct. it has been incorrection basically in the market, and we look at another pattern in the market. However, if my wave 4 ends where it does now, or just slightly above, then I'll be expected that wave 5 will start moving higher above wave 3, and then I can put a buy position in as soon as it starts moving higher. And then that's how you basically ride the waves, surf the waves, let's say, and you start looking at how you can make some profits in the market. We have to bear in mind, however, as well, that the impulse will only be accepted if wave 3 is not the shortest. At the moment, it is the shortest because wave 1 is quite long. And we've got wave 4 coming down. So wave 5 pretty much has to end roughly about where I've put it in order for it to be an impulse. So with that being said, I'll put a buy position in roughly about now. And then when wave 5 starts moving higher, I'll have to close it because it cannot be bigger than wave 3. So based on the rules and guidelines that we looked at earlier for impulses, wave 3 is never the shortest wave. Wave 2 never moves beyond the start of wave 1. Wave 3 always moves beyond the end of wave 1. And actually, in this scenario, it could be a truncation. So going back, we could have wave 5 ending about here roughly. But again, if I put a buy position in, I'll make sure my stop losses are in place, and the buy position and the wave 5 will not end higher than or further than the length of wave 3. So this is how you can use this Elliott wave indicator based on the rules and guidelines for each pattern. And again, leading diagonals as well. If I had a leading diagonal now, so I'm looking at this to start my impulse that we've just seen here. So 1, 2, 3, 4, 5. Let's just go back to the MT4 platform. So this is my 1, 2, 3, 4, 5. And then that's beginning my wave 1 of an impulse. However, as I said, it is speculative. We have to look at all the facts going into looking at the patterns to see if this is a realistic outcome as well. But the good thing about Elliott waves is, especially with this indicator, we can look to see what is happening there. So that pretty much brings us to the end of the presentation. As I said, any questions, I'll be online for a little bit more time, roughly about 10-15 minutes, or even longer if you want to ask any questions. And just let me know if you would like the slides sending to you to your email address, and I'll be happy to reply to any email questions that you may have about Elliott waves and about the webinar as we go on. And please join me next time for the next webinars, where we'll be looking again at harmonics, more into Elliott waves, candlestick patterns as well, and also how to trade the gaps. Now, the opening gaps of a market weekend, the rollover gaps, and we look at exhaustion gaps and also common gaps as well. So this is something that we look at in the markets going forward. And as I said, anyone that wants to have the slides, let me know, and I'll be happy to send them to you roughly in the next 10-20 minutes or so. So once again, thank you for joining me. And it's been a real pleasure again to host another webinar brought to you by Orbex. And I'll look forward to joining me in the next one, where, as I said, I'll be looking at more patterns in the market and how we can jump on these trades and opportunities going into the next webinar as well. So thank you once again, and bye for now.